Robinhood came out with their own ETF. That's what we're talking about today. Okay, real quick, if you're new here, I'm Austin. I'm glad you're here. I'm a co-owner of cloudmusicsuite.com. On this channel, we talk all things money and personal development. So if that sounds up your alley, go ahead and subscribe. As a thank you for subscribing, here is a picture of my beautiful kitty cat. She's right over there off camera right now. She's so beautiful. Okay, let's get into this. So Robinhood is an investing app. They kind of changed the game around stock market investing for the retail investor. Retail investor meaning not big money, not billions of dollar hedge fund, but like you and me and anyone who's, you know, even someone who has up to 10 million plus or more than that inside of their brokerage accounts, that's still considered a retail investor. So not institutional money, not a big hedge fund, just you and me. So Robinhood kind of changed the game because before Robinhood, you had to pay a fee up to like $19.95 that is, for every single trade that you wanted to execute. That would be a buy or a sell. So it was really hard for the retail investor to get going in the stock market because it's hard to start with a small amount. And me personally, I suggest everyone, even if you're big balling, always start with a small amount so you can learn the psychology around how to consistently invest in stocks and be ready for the ups and the downs, etc. Anyway, so Robinhood made this ETF, and it's called the Robinhood Investor Index. It says, see how customers like you are investing. All right, so it's definitely meant to go toward the retail investor who doesn't exactly know what stocks they're supposed to be buying. So I don't love it right off the jump because it seems a little, preying on certain people who don't have as much knowledge in the market as others, and they just want to kind of go with the crowd. That's just my first thought whenever I first heard that Robinhood had an ETF. I could be wrong. We'll keep looking and reading, and I'll give my review here in a little bit. But they basically say that the Robinhood Investor Index tracks the performance of the top 100 most owned investments on Robinhood in aggregate. So that's interesting. I would say that Robinhood investors are not the most sophisticated investor in the world. This is not a dig on anybody. This is just facts. Like the average account balance for a Robinhood account is like in the hundreds somewhere. And then we look at other, more established brokerages where people might be holding their money. The average is way, way, way higher. So anyway, just an observation. So let's get into the top 10 investments. It doesn't tell me exactly what percentage. I'm not sure if this is trading yet. So there's two things I can't find. And one of them is that I can't find the exact percentages, but we'll just talk about the top 10 investments inside of this Robinhood index here. So we've got Microsoft, we've got Disney, we got Tesla, we got Ape, which is AMC preferred shares. We have AMC, we have GameStop, Ford, Apple, Neo, and Amazon. So, all right, so while I was editing this video, between the time I recorded it and between the time I edited it, Ape shares, AMC preferred shares, that APE ticker that you see on the screen there, got dropped out of the top 10. So instead of Ape being in the top 10, which I had a lot of negative commentary about, they replaced it with Lucid in the top 10 holdings because the AMC preferred shares had gotten so decimated, so poorly, performing so poorly that Lucid joined. So you're basically getting automakers, more of the trendy automakers, and then big tech in this top 10. So if I'm going to get automakers and big tech in the top 10, why don't I just buy the index? Why don't I just buy S&P 500? I don't know. So you'll see the rest of my comments as we move through the video here. But anyway, just wanted to say that Ape had been completely dropped out, got replaced with Lucid. All right, back to the video. Just starting to analyze this. Apple, Amazon, Tesla, Microsoft. Big tech, big tech, big tech, big tech. Can I hate on big tech? No. And over the last little while, big tech it's had a rough time, A lot of big tech are down 30% plus. Tesla's been holding up nicely. Microsoft's been holding up nicely. Apple's been holding up pretty nicely. Amazon's gotten pretty disrespected over the last little while. So, I guess if you're buying into an ETF, you really don't care about valuation. So I'll leave that, to the side since we're talking about a fund here. And then we got Disney. Not my favorite play, but I guess I could get behind it. We got Ford. I am more bullish on Ford today than I was 2 years ago. Let's just say that. We got Neo, another auto manufacturer. So 3 auto manufacturers in the top 10 holdings. Not my favorite. and then 4 total big techs. So that's interesting. And then we got AMC, and then AMC preferred shares, and then GameStop. So let's start with what I think is the worst, where if you're buying this, you are making a horrible mistake. If you're buying a fund that holds AMC as one of its top holdings, don't buy that fund. Like, what are we doing? AMC is a terrible, terrible company. If you were inside, all right, that's my opinion. If you're buying that individual stock at a good valuation, right? And for me, I probably wouldn't consider stepping in until it's in like the $2 range if I'm looking at it for an investment purpose. If you were on the hype train of AMC and you were in it for the cause or whatever, sure, whatever, do your thing. But inside of an ETF, no way. Like, you have no control over where you buy those AMC shares at. Okay, so it's just tracking what AMC does on a daily basis, which is not great normally, and it's probably not going to be pretty over the next however many years. And then they have APE, which is AMC preferred shares. I'm not a preferred shares investor whatsoever at all. I know Warren Buffett does that, but most people who are watching or even considering buying this probably don't know what preferred shares are at all. Don't buy it if you don't know what's inside of it. All right. Those were so that they didn't have to issue more AMC stock. All right. So they didn't have to dilute people as much. It is what it is. Definitely should not be in the top 10 of an index that I would buy. No way, Jose. Next one is GameStop. I will never buy GameStop shares. I've never bought GameStop shares. I would never consider buying GameStop shares. I don't care what the valuation is on GameStop. I will never buy GameStop shares. Never would I ever buy an ETF that has top 10 holdings GameStop in there. Once again, if you were part of that movement or whatever meme movement, cool, that's great. If that was your cause or whatever, and you were just doing it for the memes, different story. If you're doing it for an investment purpose, no, bro. Like, no, not it. Disney, while we're looking at the entertainment based. So I like Disney. I like Disney's business model. It's a cash flow machine. They've had a rough time over the COVID times, and then now we're in an inflationary time, right? And we're in a recession. So inflationary time, recession, just got out of COVID. It's been a really, really tough sledding for Disney. I love the Disney Plus platform. There's a lot of competition in the streaming space, but it doesn't seem to me as though there's that much competition with Disney Plus specifically. Like, if you want to watch the Disney Plus shows, you have to have Disney Plus. And there's a lot of hardcore Disney fans who love everything that Disney Plus is ever going to release. So I like Disney a lot. It's not a stock I personally own. It's not a stock I'm personally looking at, but I can see it inside this top 10. Okay. Talking about the big techs. Apple, I think, is a good cash park for the next few years, meaning I'm not expecting it to grow in value over the next few years. It hasn't gotten hit like these other big dogs. It's the biggest market cap in the world. It's trading at a rich valuation for Apple specifically. They've typically been around a 16 PE. Now they're around a 22 PE. So just on a historical basis, Apple's a little rich in comparison to itself in prior years. So I'm not personally interested in buying Apple shares right now, but I do think it's very safe. I do think there's a low percentage chance that you're going to lose a ton of money over a 5-year span. So if you want a cash park and you're waiting for an investment opportunity, but you want to be invested, owning Apple shares makes sense to me. Owning Apple shares inside of a ETF, I personally wouldn't be interested in that. Amazon has been heavily depressed lately. I think buying Amazon shares straight up would be a good thing. Once again, buying it inside of an ETF, yes, you'll get some of that appreciation as the ETF rises with the underlying securities that are inside of it, but you could just buy Amazon straight up and you'll get all the upside. Yes, you get all the downside, but you could potentially get all the upside as well. Microsoft. I don't love Microsoft. I do love that they're business-to-business. Business-to-business companies typically command a higher valuation. So if I'm working business to business, the transaction volume is much higher. So I don't have to have as many customers. So, I'm not a Microsoft shareholder, but I'm not opposed to Microsoft. I see it very similar to Apple as a cash park. There's a small dividend. You'll collect that dividend while you chill with some equity. It's not bad to be invested in Apple and Microsoft. I'm just not in it for the upside because I don't see that much upside over the next 3 to 5 years. Over the long term, maybe, sure. But 3 to 5 years, I think it's going to be, not to say dead money, but a slow grower over the next few years. Tesla, I just think the valuation is way too high. Yes, Tesla's firing on all cylinders. Yes, Tesla is killing it. Yes, Tesla management team is doing a great job. They're expanding into new markets. They're expanding their charger network. Yes, I love Tesla. I love the cars. I'm a Tesla shareholder. I haven't bought any new shares for years. Okay, I've just been holding and riding and watching this story play out. I just personally am not interested at the valuation it's at now. Doesn't mean it doesn't have upside. I think it has more upside than Apple and Microsoft as I'm looking at this thing here. So yeah, I'm with it. Tesla being in this makes a lot of sense to me. Ford actually makes a lot of sense to me being in this as well. So Ford has the number 2 EV that's selling, or the company has, it's the second best selling SUV that's an EV in the United States at least. And it's the Ford Mach-E. So I really like the look of the car. I like the idea of the car. I don't love that everyone's going all the way electric, but it doesn't seem like Ford's going all the way electric. They're just going to have a big branch. And of all the legacy automakers, I think Ford's going to do it the best. I could be wrong, but Tesla's very much American made. Ford's very much American made. I like American made things. I like American made cars. Ford valuation, very respectable. Very respectable. I've considered opening a Ford position, believe it or not. I never thought I would say that, but I'm considering it, and I have considered it in the past. So yeah, that said, NIO, I'm going to stay away from NIO. I wouldn't touch it with a 50-foot pole. I'm not going to be invested in any Chinese stocks, maybe ever, but definitely not over the next few years. If we get a new administration and the Chinese-American tensions are a little better and we have better terms, maybe I'll consider it, but probably not going to be investing in any Chinese companies, and NIO is involved in that. Unfortunately, I do like the company. I think that they have a pretty nice moat around them, competitive moat around them. It's hard to challenge them in what they're doing, but not going to be buying NIO shares, so I wouldn't want this to be in my index. So I basically only like 5 or maybe 6 out of the top 10. AMC preferred shares, no. AMC, no. GameStop, no. NIO, no. I can see the argument for having Apple and Microsoft shares. I can see the argument for sure on Amazon and Tesla shares. And I'm with the Ford pick depending on the valuation, and I'm with the Disney pick depending on the valuation. So not the worst top 10 I've ever seen, but having the AMC and GameStop, I mean, it's just not going to be, it's not going to help the ETF's performance. It was a meme. It's over. It's not going to come back. We're not going to get this crazy run up in these meme stocks again. I could be wrong, but that's just my opinion. So one thing I can't find is the freaking expense ratio on this thing. So this is my qualm. You can just look at the top 10, and if you love that top 10, dude, you can buy fractional shares on Robinhood. Just go split up your money into these 10 stocks. I don't know, you have $1,000, buy $100 of each one, and then you've got this already. So if you love that 10, Microsoft, Disney, all the ones I've already said, they're popped up on the screen right now, just go buy those inside your Robinhood account for free and just hold them and see what happens. And if you like it, that's awesome. You don't have to own this Robinhood Investor Index or whatever they're calling it, because there's going to be, for sure, a fee. There's going to be an expense ratio that you have to pay, and that basically comes out of the performance of the ETF. So if the ETF returns, 5% a year, which I doubt it'll even get to 5% a year. I'm not bullish on this ETF whatsoever at all, if you can't tell. So if it gets 5% a year and it has a 1% expense ratio, now you effectively have a 4% gain. That's not good. That's not good at all. If it's going to get a 5% gain and those top 10 are going to be the leaders of that, invest in those top 10, get your 5% gain. If you're happy with that, cool, that's good. And you didn't have to pay any expense ratio, and you didn't have to buy this little Robinhood Investor Index. And I don't know if this is going to be offered on anything other than Robinhood. So if it's not, you can move your money over to somewhere else if you want to leave Robinhood and go to SoFi or TD Ameritrade or Schwab or JP Morgan or something like that. And you can keep these same 10 stocks if you really love these 10 stocks without having to worry about being invested in the Robinhood platform into the Robinhood Investor Index while paying fees. So my take on this, if I had to rate it out of 10, I can't see all 100 stocks. I can only see the top 10 stocks. I would buy the S&P 500 before I'd buy this. I'd buy the NASDAQ 100 before I'd buy this. I would definitely buy just a regular old index fund before I buy this Robinhood thing, 100 times out of 100 any day of the week. So based on that, I'm gonna give this a 4 out of 10. Some of these picks in the top 10 are just complete garbage stocks, like just flat out. So, and then we got the Chinese tensions inside the top 10 as well. So it's just not for me, okay? If I was to buy an index right now, it would be VOO or SPY or QQQ, one of these big indexes that tracks a lot of these companies anyway. If you buy the S&P 500, a lot of that's going to be Apple, a lot of that's going to be Microsoft, a lot of that's going to be Tesla, a lot of that's going to be Amazon. You're going to get Disney in there, you're going to get Ford in there. So if you buy the S&P 500, you're already going to get exposure to these companies. So I would say don't fall victim to the tricks. And I definitely wouldn't buy into this index if it was my money. You can do whatever you want, just my take. And yeah, hope you enjoyed this one. That's my review on the Robinhood index. Have a great night and subscribe if you like this. Thank you so much.